Welcome to e-learning module developed by Wisest Business Solutions PVT Ltd. Wisest Business Solutions PVT Ltd is one of the most reputed company known for its internationally appealing learning process. You may visit www.wisest.com website for more details about the college. This content is developed as part of 4-module e-learning course Finance for Non-Finance Executives. Module 1 is developed to enable the student to understand how are the financial statements prepared. If you are associated with any business organization, you must have heard people speaking most of the above words. Though they are all English words, they have different connotation in the business world. Business vocabulary derives its epitome from accountants. Accountants are those who keep record of all the transactions of the business systematically, every day, such that by the end of a particular period, any authority can know the exact profit or loss made by the company and also can get an idea of where the business stands as on that day. Well, it's not as simple as said. Accountants follow a particular process in recording the transactions. And learning this process is the objective of this module. Because businessmen speak and understand the words of accountants in their daily life, we can say, accounting is the language of business. Business organizations can be owned and run by an individual called sole ownership or a group of individuals called partners or legally registered and formed firm with less than 50 people called privately owned company, or when it is owned by more than 50 shareholders it is called public limited company. Let's suppose you start a restaurant business and at the end of the first day's business, you are curious to know how did the first day go. You check the cash box that has quite an amount of cash. You are just about to smile at the cash you made for the day. One of your vendors, who had supplied vegetables, comes and presents his bill for payment, which was more than the amount of cash that was accumulated in the cash box. Then comes the gas supplier, then comes the furniture supplier, and then comes the local municipality asking for license tax. You are wondering what just happened. You have cash in your hands, but it's not your profit from the business. Well, you know you are missing a point here. You need to realize that this might be an issue every day, and you will never be able to know the exact profit you make, unless you keep record of all the transactions of the business in a systematic manner diligently. This process is called bookkeeping. This calls for the need to start recording the transactions systematically. There are 5 elements of bookkeeping: assets, liabilities, capital, income, and expense. An asset is what the business owns, like building, equipment, furniture, cash, etc. A liability is what business owes to outsiders, like bank loan, bills to be paid, etc. Capital, or also called owner's equity, is what the business owes to the owner. It may be noted here that owner is treated as a separate entity who is almost an outsider for the business. It is as if the business is dealing with the owner by taking assets from him and returning profits generated to him at the end of the period. Income is what the business earns as revenue by selling goods and services. By the ways, income is not profits. Profits are part of income. Expense is what the business spends to conduct the business, like the business spends on buying the raw materials, paying wages and salaries, advertising, etc. An expense needs to be distinguished as a capital expense and a revenue expense. When the business spends on buying an asset, that would be a capital expense, whereas, when the business spends on day-to-day requirements, that would be a revenue expense. When a business in any given period of time earns income more than what it spends, revenue expense, the business is said to have made profit. When the income is lower than expense, the business is said to have incurred loss. Thus, we can say income expenses equals profit or loss. Let's say a business has earned an income of Rs 100,000 and incurred expenses of Rs 80,000 in a given period. We can say the business has made a profit of Rs 20,000. At the end of the period, once all the business transactions are recorded, business creates two major summary reports, one called the profit and loss account and the other called the balance sheet. Profit and loss account lists all the income items on one side and expense items on another side, and finally compares total value of income and total value of expenses and gives the value of profit or loss the business made during the period. Balance sheet lists all the asset items on one side and liabilities and capital items together on the other side and tallies both sides. This gives an overall idea of the quantity of funds sourced by the business both from the owner and the outside lenders, and the application of funds into various assets. Accountants use dual effect principle in recording the transactions. Every transaction of the business will be studied to determine two effects. These two effects will be on either of the 5 elements we just discussed. Accordingly, they will make entry the transaction in respective accounts. Let's take a business transaction for example. Let's say business buys furniture. First we will analyze the transaction to identify the two effects. First, business purchased furniture. Furniture is an asset. The value of the furniture in the business after the transaction has gone up. Hence, the first effect of this transaction will be on the asset account. Because the value is gone up, asset account will increase. Second, business must have paid for the furniture by cash. Cash is an asset. The value of the cash in the business after the transaction has come down. Hence, The second effect of this transaction will be on the asset account. Because the value has come down, asset account will decrease. Let's take another example. Let's take the example of a most regular transaction of businesses. Let's say business sold goods. We will have analyzed the transaction to identify the two effects. First, business sold goods. Sales is an income item. The value of the income in the business after the transaction has gone up. Hence, the first effect of this transaction will be on the income account. Because the value has gone up, income account will increase. Second, business must have received cash. Cash is an asset. The value of the cash in the business after the transaction has gone up. Hence, the second effect of this transaction will be on the asset account. Because the value has gone up, asset account will increase. What if the business made a sale, but the customer did not pay cash immediately and promised to pay later, which is a usual business practice? If the sale was made and the customer did not pay cash now but promised to pay in future, then such customer will be called a debtor. A debtor is one who is obligated to pay us in future. We will have analyzed the transaction to identify the two effects. First, business sold goods. Sales is an income item. The value of the income in the business after the transaction has gone up. Hence, the first effect of this transaction will be on the income account. Because the value has gone up, income account will increase. Second, business created new debtors. Debtor is an asset. The value of the debtors in the business after the transaction has gone up. Hence, the second effect of this transaction will be on the asset account. Because the value has gone up, asset account will increase. Let's take the example of a most regular transaction of businesses. Let's say business sold goods. We will have analyzed the transaction to identify the two effects. First, business sold goods. Sales is an income item. The value of the income in the business after the transaction has gone up. Hence, the first effect of this transaction will be on the income account. Because the value has gone up, income account will increase. Second, business must have received cash. Cash is an asset. The value of the cash in the business after the transaction has gone up. Hence, the second effect of this transaction will be on the asset account. Because the value has gone up, asset account will increase. Let's take another example.